There's 3 sections. I'm going to do some general information in the first sections. Then I'm going to go in performance of Kai-Zen with my number crunching. These have been changing daily as I've tried to get them correct and whatever. And last, we're going to go to an online site and show you how kind of Kai-Zen works. This phrase was just composed a little while ago. I actually did it for a class in Steve Rich's training, so I could give to them a quick summary of what I do. So we employ a retirement income strategy utilizing life insurance with a significant portion of the premiums being financed. So do you see the word premium finance in the title? So there's where the premium finance comes from. And the name of the product is called Kai-Zen. A company in Dallas designed it and supports me with it. And I'm a one-product company. I'm not going to sell term insurance. I'm not going to sell normal life insurance. I'm going to sell Kai-Zen. And I don't think there's another company in the country that's going to sell only Kai-Zen. And even if they get close, they'd probably say, we'll sell the other insurances too. But most likely, they're an investment advisor, and this is just one of their tools. And I'm using it as my sole tool. You can decide if that's good or bad. The financing is approximately 3 to 1. We call that leveraged. So we're leveraging up 3 to 1. An example is if you put 100,000 in, then we have a bank put in 300,000. This is a cool quote I found recently. If compound interest is indeed the 8th wonder of the world, then leveraged compounding is certainly the 9th, 10th, and 11th. Isn't that a good one? You're going to see that I believe that we should be using leverage. Who bought their last house for cash? Stand up. We want to recognize you. Oh, okay. We'll have to, so everyone uses leverage. Everyone uses leverage. Do you know of many people that don't use leverage? When we use Steve Rich and his products as he helps me with my newsletter, is that leverage? Yeah, he's helping me leverage my company. So we really use leverage in almost everything we do with no collateral, no personal guarantees, no loan documents, no interest payments, no credit checks. Normally, premium finance comes with collateral. And it's usually for the people that are ultra rich. Kai-Zen can be used for a lot of us. This is a slide that I did last night. I think it'll be helpful. It's awfully colorful. Kai-Zen can be used for 2 groups of people. The blue on the left is for individuals and families, and the green is for companies. So in the blue, you can do retirement income, and that is the primary purpose of Kai-Zen, and whatever the other uses you use, it's also part of retirement income. Fixed income replacement, meaning I don't want to go into bonds, give me another option. And wealth transfer is when you want to, you're trying to figure out a good way to transfer your wealth to Heidi. And and she wants to make sure I do it well. Is that right? So let's take the first column around there, the retirement income. If you're less than 50 years of age, Kai-Zen is a go. It's green. You can't take income until 15 years. And if you add 15 years to the 50, you're going to have 65. And that's the traditional age people retire. Certainly not some weird people. Oh, I won't talk about who. Never mind, I will eventually. But anyway, I put yellow from 51 to 55 because that could be green, because if someone's retiring at 70 And maybe most of us should nowadays with our living longer. Then we could have income starting at 70. They will not sell a Kai-Zen product to someone over 65 with them as the insured, the owner. So I put in orange, 56 to 64. It can work, and the numbers will look good, but it's going to be work a little different. If you purchased it at 60, I mean, we're waiting 15 years, we're waiting till 75 to get an income. Maybe that's too long for you, but it could work because you'd spend more in those early years waiting for your 15th year with Kai-Zen to fill in the end part. The wealth transfer is a different color because I can do a wealth transfer for Heidi. I'm buying the policy on her, and so even though I'm over 65, I'm not buying on me, I'm buying on transferring these assets to her as an estate planning effort. If I'm less than 55 years of age, the insurance company will not let me purchase it on Heidi unless I have one first. But if I'm over 56, I don't have to have one. In fact, I don't qualify. I don't get to purchase Kai-Zen. And then the green, the employee benefits, buy-sell agreements, key person, these are pretty phenomenal. And these can be the way to keep employees without having a 401k and without the expense of a 401k. And you can be selective. You can discriminate. You can do a plan for, Brady, who's your best employee?
Phil.
All right, you can do it for Phil and nobody else. And he doesn't have to tell everybody, but you can keep him, you can do a benefit for him. You can do this as a buy-sell agreement, key person. Kind of the 4 qualifications. You need to possess sufficient financial resources. It takes 5 annual payments from $16,000 to 44. The 44 is a 64-year-old. The 16 is a female at 18 years of age. You cannot buy Kai-Zen if you're younger than 18. You have a minimum of 15 years available for growth before taking income. You have a need or want and willing to sacrifice to save for retirement. Is there a lot of people that have needs and wants but are not willing to sacrifice? I think so. Has excellent or average health. Can't have rated health to have a Kai-Zen. Does that help? I put this together as my laundry list of all the features. I'm not going to go over every detail. They'll kind of come out as we go through the numbers. 5 annual payments, is tax deferred, becomes tax-free, withdrawals, market-like performance, safety, no downside risk, approximately 3-to-1 leverage, 60 to 100% more income. This is a catch-up plan. If you haven't been putting enough aside, this will help you catch up. It is built on a life insurance policy, so you have the death benefits, you have the accelerated living benefits, chronic illness, critical illness, terminal illness, all these riders on the side. Much more liquid than certainly an IRA or a 401k. You're not going to add it to your taxes and pay taxes or a penalty of 10% if you're younger than 59 and a half. And here's all the risk it helps with. No tax risk, market risk, downside risk, no sequence of return risk. I've actually got a seminar that I've kind of fleshed out on the sequence of return risk seminar. Maybe that would be really boring, but I think I'll do it one of these days. Reduce liability risk. I won't go into that too much too. And reduce lack of capital risk. That's the big deal. This is the new slide as of last night. OakTree Premium Finance, our 10 times business plan. You've asked this question in the last 10 minutes. You've said to yourself, what in the heck is Jim Barlow doing this for? I know he's old. So 73, okay, well 73. I know he's 73. what in the heck is he doing this for? And the answer is, darn it, I want to. And I can't get rid of the thought, sorry, of helping people somehow. So far, this has only cost me money, but I see it as a way it's going to be a good company, and this is kind of the plan to eventually have me not in the business. So the first circle is just running the business, superior customer-facing systems from our marketing, figuring out people's needs, wants, their explorations, solution delivery, regular service. The second part is I want to find people with like-minded thoughts that like the product, they're passionate as much as I am. Then if I have some people I can kind of turn it over to, I can go on a sabbatical for a while, and then eventually one or multiple of those employees would do a buy-sell agreement. There's that information. And now we're going to get into my numbers. That's the first section. I decided to give this a name. Alchemy is the art of transformation. I was looking for a cool quote about alchemy, and how do you say his name? Paracelsus? Paracelsus? He was an alchemist in 1493 to 1541. He was trying to turn lead into gold. They were serious about this. They were really working hard at it. I've actually read a couple books about that history, and it was kind of fun. So I'm going to try to do some alchemy today and show you how you do it. For you analyticals, keep an eye on my numbers, make sure I'm being honest and not cheating anywhere. We're going to start with a Vanguard 500 index. Vanguard is the low-cost producer in our country. Their internal fees are lower than everybody's. Nobody has ever come close to being as low a fees. They're a no-load fund company. You can call them up on the phone and say, I want to buy your Vanguard 500 index. You don't need to use an advisor. Now, of course, I was an advisor, and Scott Cheshire, my son-in-law, is an advisor. But here's an avenue that you could buy a stock fund with the lowest fees possible. So I haven't put any cost involved in this. Since inception, this new version they have has averaged 11.95. There's the down years. I added all 2001 and 2 together for the 3 years was negative 43. There's 2008, and last year wasn't so cool. If you put $100,000 at this average of 11.95, and then you paid long-term capital gain taxes plus 5 for the state, you'd net $8,962.50. Did I round up that 8.64 a little bit too much? Well, 8.64 is your net return. Should anyone have 100% of the retirement in the Vanguard 500? 100% in the stock market. No, shouldn't do that. But I wanted to show that 11.95. So here's a balanced fund from Vanguard. The same concepts, low cost producer. Their average return since inception is 7.52. Good performer, good solid fund. Oh, did I leave off that number? I left off the return number. Oh well, it'd be the 7.52. 5.64 would be the net return on that one. Sorry. So I didn't do all my numbers last night. I guess I was getting sleepy or something. All right. So remember that's 5.64% return. Next, I'm going to go to an option inside National Life's insurance company. They have an index fund called the Pacesetter. Now, this is a volatility-controlled index. We really don't want to go into how that works too much. Its 20-year average is 5.9. And inside an index universal life policy, you have 0 down years. You can't have a negative year. The way they've structured it is no negative years. So that is the average from 20. Notice the 5.9 is lower than the Vanguard Balanced Income Fund, but you have more volatility and you've got some negative years in that other option. But maybe you should have some in that Vanguard balanced. I could make a compelling story of why you want some. Inside an indexed universal life, they give participation rates. So they not only give you the 5.9%, but they give you some percentage above that. On the side, I put there in 2023, this year, they're giving 215% participation on the 5.9. Last year, the participation was 130. The reason why it has gone up is because interest rates have gone up. They have more money to buy options, which we won't, I could go into detail how that happens, but we have more money to buy options so they can give you 215% of participation. I didn't want to use 215. I did call National Life and said, what's your average participation rate since PayCenter began? And his answer was, we've never calculated that. So this is the best shot I can give you. I'm thinking last year was a low interest rate environment, and now we're in a higher interest rate environment. So I've averaged the two. Does that seem fairly fair? All right, so we're going to give 172% participation, and that's 10.15%. Now, on the Vanguard, we had no cost because we're buying it direct from the fund, but this is a life insurance policy, and you all know that life insurance policies are expensive. You've heard that. Everyone's heard that. So here's how expensive it is. On the side there, see that 10-year average at 3.5? That was calculated by NIW. That's the founders of Kai-Zen. And one of the training classes they had, they're analyzing a 50-year-old, and they came out and said the average cost has been 3.5. So I accepted that as fact, but I would like to know a little bit more on 20 years and everything else between. The other night I started working out a formula using the spreadsheet, and I think I figured out this formula, and I figured out that MC stands for my calculation, and I discovered that in this Kai-Zen illustration I had in front of me, that the internal cost was 12%. Normally in a life insurance policy, the internal fees that first year is the whole thing you put in. Everything you put in went, so it's 100%, not 12%. But Kai-Zen does a really good job of keeping the fees lower. I'm pretty sure from thinking through the numbers that at 20 years, the average expense is going to be about 2%, and the average expense at 40 years is going to be 1.25. And I don't think it's going to go a heck of a lot lower than that. Now the annual rates in the 40th year will be lower than 1.25, but we're taking all the average expenses. So in my third column, I've subtracted 2% from the 10.15 to get a net of 8.15. How am I doing? Am I being fair to Vanguard? I'm not cheating too bad? I'm trying not to. So now we got 100,000 at 8.15, so we have 8,150. It beat the balance fund. It didn't beat the all stock fund. Next, we're going to use the borrowing. This is the Kai-Zen part. We're going to borrow 3-to-1. We're going to borrow 300,000. And I did that 8.15, and I actually made it 2%. Because over on the right, the worst 15-year spread since the 1930s has been 2%. That's the worst it's ever been. Now there's been individual years worse than 2%, but over a 15-year period of time, and this is not a short-term product, you could count on making 2% on your borrowed money, I'd be forever. But there we go, 2%. So on the borrowed money, we're making $6,000. And over on the right column again, since 2013, when the first Kai-Zen policy was issued, the average spread has been 4.08. I think we're using a low one on my example here. So now we have a net of 14,150, 14.15%. I've beat the stock market. That's not bad, huh? And guess what? That was tax-free. And guess what? That's 2.5 times more than our balanced fund. Can we do better in some weird thing called a life insurance policy? We can't. It's not as clean, maybe. Let's show you some other numbers. So let's start with 15 years as earliest you can take an income. So 100,000 for 15 years in the Vanguard balance. That's going to grow to 227,000. Then if we start taking income at 5.64%, we could have $12,844. The Pacer index would be that 14.15. It'd grow to 728. And if we took 14.15% out per year, which probably isn't a wise decision, but we could, that's 103, so it'd be 8 times more income. I think that's alchemy. Is that alchemy? Or is this just magic? Maybe it's magic. Whichever you want to call it. Okay, how about 20 years? 20 years, there's the same story. And now we're 11.8 times. Instead of an income of 16,000 a year, we got an income of 199. Or if we go 25 years, instead of 22,000 income, we got an income of 386,000. Would that make a difference in someone's retirement? Whew. That's the end of part 2. We're going to go to this website, but before we do so, I want to tell you some information about it. So in the middle, I've told you that my projected rate was 14.15 with 172% participation, a spread of 2, and the Pacer average is 5.9. In this illustration system that I'm going to show you, the maximum illustrated rate right now is 6.42, not 14.15, 6.42. And the spread is not 2%, it's 0.9. It's half of what has been reality over a 15-year period of time. Who's controlling that? The NAIC. This is the National Association of Insurance Commissioners. Insurance industry is not regulated by the federal government. It's regulated by an Association of State Insurance Commissioners. I think that's good. Now, I think this NAIC is a little bit non-realistic in those numbers, but that's who I have to live with. Now, if anyone loses money in life insurance in our country, what's going to happen? Senators and representatives are going to say, we can't let this happen. We will regulate those bums, and it will happen. And so the state insurance commissioners, do they want that to happen? They are self-regulatory. They are going to do a bang-up job to make sure the federal government never gets into this. NIW, the company that invented Kai-Zen, designed this website. They call it Interactive Learning Information Assistance, ILIA. And this ILIA system has service things for me and a lot of things for potential buyers. And on the left side here is the index. And we have a video to start with. We have explanation of how things are working. They talk about the product with visuals. They talk about the leverage, the borrowed money, which I haven't really covered this at all. They talk about the plan details. They have testimonials. They have a lot of information. you tell me if I'm wrong or right. I think we're living in an Amazon and an IKEA world. Anyone want to guess what I think I mean? I think I go home and decide I want some weird thing, and I go on my computer, and I probably can just go to Amazon and type in some words, and all of a sudden, that's what I want. Was that the right one? Well, Amazon will tell me if it's like they like it. And I could research this thing. I don't need to talk to Chuck Mon to see if this is worthwhile or not. But he would give me the truth anyway. I think we do buy a lot of things on our own research on Amazon. Is that true? Going to Lowe's might be more of a problem. I don't even know the question to ask sometimes. The IKEA world is when we take that thing home we bought from IKEA and we put it together, we feel cool. We built something. I guess I could call it the Lego world and say we feel cool after we built this Lego. I built a bookshelf with IKEA and I even made mistakes, but I still felt cool that I built that. I follow the instructions. You can build your Kai-Zen without talking to Jim Barlow. Now, I don't mean that you want to do that, but you can. And even down here, see this? After you're enrolled in the site, you can even enroll and do all the paperwork. And so in today's day and age, nobody's doing paperwork. We're doing it online. So I could actually sell Kai-Zen to anyone in the country. My clientele, it doesn't matter where they are. I don't need to see them face to face, but I like to take people to lunch. They can enroll on their own and they can get their own questions answered. I'm going to go to the estimate my benefits because I think this is cool. There's two versions, the quick results estimator and the custom design. And the quick estimator, you put in your age, your sex, and you slide around how much you want to put in. And you push the calculator button. And in this quick one I just clicked, you have 5 annual payments. That's the gold piggies. The green piggies right below is the bank is matching you for that first 5 years what you're putting in. And then the next 5 years, the bank is going to put in your payment, what you're putting in, plus they are putting in. So there's payments going in for 10 years. And in this sample, $72,000 was your contribution of $360,000. Now I did a pretty hefty number here. And the lender put in $907,000. Literally, there is no collateral here. The lender is saying this policy is adequate collateral. We don't need anything else. So we have $1,267,000. Then I'm going to click this next one, next benefit distribution, and this gives me all the details. The initial death benefit is $4 million. With the borrowed money, even though it's only making 0.9 for their illustration, they're saying the internal rate of return is 8. And at age 65, this 18-year-old could start getting a check per year of $902,000. In the cumulative, they take out $23 million by age 90 and still have a death benefit. Let's change and go to the custom design. Brady, are you willing to be my guinea pig? So Brady, B-R-A-D-Y. Peterson. Yeah, I was going to get to it. It was coming. What's your birth date?
11/5 of 76.
So we're going to ask him a few questions. So don't get. So are you average health or excellent health?
Probably average,
You think so?
unless you tell me otherwise. I'm excellent.
Well, the numbers look better on excellent.
Let's do that.
But the average would be good too.
I would say I'm average.
All right, I'm going to go with average. Remember, the numbers would have been better. Does the client use tobacco or marijuana?
No.
All right. Then we're going to go to the next questions. And now we're going to decide, do we want just to deal with death benefit, or do you want to have an income plan? And usually the historical is the income plan that we want. And for Brady's age, his minimum is $21,350 per year. Can you put in 50,000, or do you want to put in 100 or 25,000? You tell me.
We could probably do 25.
All right. So now you're not committed yet. So okay, we're doing 25,000 a year, and then he can also decide when he wants to start income. Is 65 a good age? What would you like?
Yeah, 65 is fine.
Okay, now if we want to go earlier, we can. If we want to go later, we could even extend the distribution. Change the calculations. 90 is the traditional one we do, but it's not in stone that you have to do that. Well, let's view the results. Because we went to the custom, it's stress testing this and analyzing it, and it takes about a minute. You've seen the piggies before. Now we have his contribution of $125,000. The bank put in $244,000, and now we're going to go to the benefits. And so the initial life insurance is $568. A little comment on that. We're designing this thing to give a retirement plan. We're trying to keep this death benefit as low as we can with as much money we can stuff into this thing. And so with the money, the $25,000 per year with his age, this is as low as we can get the insurance. If he wanted 600 or $1 million, we can adjust all that. At age 65, we can start giving you a check of $27,000 tax-free. From then until age 90, that's $702,000. Remember how much he put in? $125,000, and he's pulled out at age 90, $702. This is kind of magic or alchemy. It is pretty cool. And this illustration system is using lower numbers. They're being compliant and making it look they're having the spread of 0.9, so they're even being more conservative than I probably prefer. And now we're going to compare this with options. The options is here's the Kai-Zen, and the blue is the total income from 65 to 90. The gold is the life insurance he has. And if we bought the same thing without the borrowing, this would be it here. And I'm going to go below and show you the numbers. Well, in fact, let's just do that. Let's go to the numbers. So here's the comparisons. So he's getting an income of $27,000 at age 65. If we do the same thing without the leverage, is $22,000. I believe the 27 is too low because they're using a spread of 0.9. So I got to live with them. If we did this on an after-tax basis with the same performance numbers totally being fair, it'd be an income of $18,120. And if we did it in an IRA 401k, the same amount put in, it would be $22,676. Kai-Zen beats the competition when it's same numbers all across the board. This software is available. You can get a password to log in. But one more thing before I do that, I want to go to this view illustration. So here's a client proposal. So I could print this out, And so Brady has all the details in a presentation form. Not major explanation, but a lot of details on what's happening, and with all the self-funded versus Kai-Zen versus going with the other approaches. And it even has down here the spreadsheet. This is the page for a 50-year-old that I was working on the other night to figure out the cost. There's all the moving parts in there. There's the borrowed money at 15 years. See this? This is paying back the loan to the bank. So right here, this is how much he owed over the years, and he's paying it back. And this is the cash value. Now, can anyone tell me why money came out, but this column didn't go down? What's going on here? You ready for the answer? We're borrowing the money to pay back the bank. We borrowed the $395 from the insurance company. That $548, $583 is still invested. We haven't taken any money out of our investments. We were borrowing from the bank for 15 years, and now we're going to borrow from the insurance company. We're going to use leverage forever. Forever. So as you start taking this $27,000 out every year, this accumulated value of the investment, it's not going down. If we stop the income at 90, at age 100, we have an account worth $7,830,000. What was this second one? Cash surrender value. If he cashed it out at age 100, it'd be at $917,000. So we have a lot of borrowed money in here. But we're making money on borrowed money forever. And over a 15-year period of time, I'm saying 2%, they're saying 0.9 for the illustration. That's okay, whatever they want to do. Leverage is how the wealthy make money. Is that true? Why aren't we doing it for a retirement plan? Why aren't we? This is it.